first off, give you my contact information if you have any questions. Okay. And then I'm going to hand it over to Jason, our Chief Investment Officer, and he'll do the official presentation. So without any further ado, let's take a look here, guys. Okay. So the market or the S&P 500 is currently down. Okay. But because of our protective hedging that Jason has put in place and did a wonderful job with, okay, we're actually showing us, well, right here to the tickets, $581 profit, okay, when the market is actually down. Okay, so our UVXY, our protective hedge, is delivering a great growth today at about 0.6%. Okay, now if we take a look at the overall market here, okay, we can look at the S&P 500. The S&P 500 currently, folks, is down 0.23% for the day. So if you're just net long stocks, I tell people, if you're on the motorcycle without the helmet on, yeah, your count's down about 0.3% right here as we look. Okay, but we take a look at our really atomic bomb-proof setup here. Okay, guys, and you can see that instead of having that drawdown, because of Jason's wonderful risk management and engineering, okay, our UVXY position is up over $1,000, and with some drawdown with UPRO and Moderna, our long positions, we're still up $563. Okay, and on a $100,000 account, guys, that represents a growth rate of 0.6% for the day for my account. And once again, if we look at the S&P 500, okay, it's down for the day. Right. So even with the down market, our clients are still growing their capital thanks to Jason. And with that, Jason, I'll go ahead and turn it over to you, bud. And folks, just real quick before I do that, if you're on a trial and you don't have my number saved yet, please feel free to go ahead and send me a text. Okay. And my number is 505-322-7515. And my name is Dean Gallagher. And with that, Jason, I'm going to go ahead and hand it over to you, bud. And we'll start the meat and potatoes here of the presentation.
Beautiful. Thank you so much, Dean. So yeah, we have 3 positions. This portfolio is very simple. It's rock solid, and it can deliver big gains over the course of time. There's really 2 core positions. We're long stocks with UPRO and Moderna. Moderna, we're looking to take profits probably around November or December, expecting the phase 3 trial results to come out and show favorable results. Now, what's interesting is that this particular virus that's spreading the globe is very stable. It's not mutating. And viruses of this nature tend to have extremely high success rates with vaccines. It's really the highly mutacious flu that makes vaccines very unpredictable and not effective. So I'm actually expecting Moderna to potentially have very high results and to be very beneficial to the elderly, who again, it's really worth the risk to take a vaccine. So Moderna has a huge opportunity ahead of us. The insiders have been selling, that's highly reported, but the big banks have been gobbling up the shares. Basically, it does look like the banks want to take over much of the control of Moderna so that they can push this for what looks like decades to come. This company actually has some pretty interesting technology coming through. So we're long Moderna. We played phase 1. We played phase 2, got in and out, and now we're playing phase 3. So that's a more in and out catalyst-based position. And again, you have 1 share of Moderna, about 6% of your total portfolio. Most of our eggs are much more diversified in UPRO, which is 505 companies. This is really a lifetime investment. So we're going to be playing the US stock market indefinitely. So that's really the right outlook for UPROs. This is your growth mechanism into the future. And we're going to talk about, are companies really growing in value so quickly to represent the increase in value of stocks? Or is it the other way around? Is it really just the purchasing power of the dollars getting crushed because the government spends more money than it has, and to make that possible, they have to print money to buy up the debt. So they're really just devaluing the dollar. So that's really critical to understand, and will help you figure out why you have to have your assets in inflationary products like stocks. And so when we look at the big picture right now in history, I'm going to show you proof that we are devaluing the dollar at the fastest pace in history. Your purchasing power is going to erode rapidly because of what we're doing at the Federal Reserve and the US government with massive deficits. And that is unfortunately just not going to change. We're going to have to devalue the currency. And this is the case for every country around the world. Every country is in the process of what we call a currency war. So I'm going to show you that almost without question, stocks are going to go up in dollar terms, regardless of their profits and earnings, simply because of what the US government's doing. Now, there are some speed bumps along the way. Anyone can look at a stock chart of the last century and see stocks just don't go up straight over time. Over the course of 100 years, of course, they've done nothing but go up. And we'll look at what is really causing that. But we also want to smooth out the curve of our returns and reduce volatility, because our clientele is primarily over the age of 55. They no longer have a new source of income. And so they need to protect those assets and outpace inflation for the rest of their lifetime. And so I'm going to argue the only way to safely do that is to be long stocks, to be long commodities, specifically gold and silver, but also we like things like oil, copper. Okay, so we'll talk about the timing of those. Right now, however, there's a major concern, a huge speed bump that we do need to mitigate risks. And that main problem is the government's on the verge of going into a government shutdown. The Republicans denied the House bill last night, and they continue to fight over the stimulus. And once you realize that about this year, it's much more, but in a typical year, a good 15 to 20% of our GDP, which of course drives stock prices, is government spending. If government spending is about to fall off a cliff, we have a huge problem. Now, we need to realize the only thing that's going to happen if we create a huge problem from not spending money at the government is we end up with a short-term volatility spike that's answered with a massive stimulus and massive Federal Reserve action, which essentially is just devaluing the dollar. So the right way to play this market is to always be long stocks, almost without question, and to hedge that position with the best possible option. Now, in the 3 years of running this service, the best way to hedge was an easy job, the 30-year treasury. You go half 30-year treasuries, half stocks, and then sit back and don't even worry. When stocks go down, bonds go up, vice versa. But what happened in March forced the Federal Reserve to artificially suppress interest rates on treasuries over the last several months. And we predicted that treasuries would no longer provide the hedge you need to safely be long stocks. Okay, so we got our investors out of the treasury market after a 3-year buy and hold. Undoubtedly one of our most profitable positions outside of being long gold. And now we're preparing for the risk of a deflationary shock. Okay, so if we can't pass the government spending because of all the drama relating to the election and the Supreme Court Justice nomination coming in Saturday, which it does look like will be passed, then we have a shock coming to the system that we do need to prepare for. Now, I'm not guaranteeing you that the government's going to shut down and not pass any spending, okay? But there is a risk, and to protect against that risk, it's very easy. The best way to do this is to be long the stock market and realize this is a lifelong position. The government has no choice. They're going to have to print their way out of all of their liabilities for the foreseeable decades to come. This is inflationary, and it makes the value of your dollar go down and the relative value of stocks go up. And we're going to go into greater detail on this phenomenon because corporations are actually burning their outstanding shares with stock buybacks. And at the same time, the US government is increasing the supply of dollars. So do the math. There's less shares representing the most valuable companies in America, and that's never going to stop. They're continually buying back their own stocks, burning outstanding shares. Meanwhile, the US government is pumping out unlimited amounts of debt, and buying their own debt by printing dollars. So there's more dollars fighting over less assets. Okay, so that's really our outlook. We have 2 time horizons. UPRO, we want to be invested in for the next several decades, okay, until the Fed starts hiking interest rates. We'll talk about when that's coming, probably not for a long, long time. I'm thinking in around 5 to 10 years, they're going to be stuck in a position where they temporarily try to hike interest rates and do quantitative tightening. And so we'll look at that. But for now, they can't. They have told us interest rates are at 0. They're going to do at least $120 billion, $120 billion of quantitative easing per month at a minimum. And if there is volatility in the stock market, they're willing to increase that quantity. Now, the catch is they can only increase QE if the government increases fiscal spending. And right now, the politics are blocking all spending. If this is not alleviated in the very near future, we could have a deflationary shock, which means stocks could potentially sell off rapidly until the government takes action and starts spending so that the Fed can ramp up quantitative easing. So that's what's at risk. And at the end of the day, again, we want to be long stocks until we think the Fed's going to hike interest rates and stop doing QE. And we want to protect it with the Ultra VIX short-term futures ETF, UVXY. So this is how easy it is to follow our product at the current stance. We are long 10 shares of UPRO. We're long 12 shares of UVXY, and we're long 1 share of Moderna. And that's per $1,000. If you have $10,000, multiply each figure by 10. If you have $100,000, multiply each figure by 100. Now, I do want to point out that if you have over $100,000, the buy and hold formula may not be your best option. If you do have over $100,000 and really closer to several million, we found that investors like to follow our trading plan, but add options on top. So rather than being so long UVXY, we actually have a portion of that buying put options when there are extreme risks in the market. So instead of just having 1 hedge, we have 2 hedges, which in some cases can be highly beneficial to our return. It can greatly reduce volatility. So in our evening webinar, if you are in that bracket of wealth, you may want to consider also following our option trades. So this is our plan. There will be a slight modification the second we get both the normal budget confirmed, which will be a big relief for markets, okay, because we're coming to a fiscal cliff at the end of the month. And then once there's stimulus passed, which I think will be around $1.5 to $2 trillion, the second that occurs, we're going to short the US Treasury market with a ETF called TTT, and we're going to go long the silver market with a product called AGQ. So that's the only modification you should expect the second the stimulus and budget are approved, so that we know the fiscal spending will resume. Okay, so that is the trading plan. It's very easy to follow. And again, per $1,000 following, you buy 10 shares of UPRO. This is a very long-term position. The only concern I have for UPRO is really 2 things. One would be if the Treasury market's interest rate were to rise extremely high to the point it became too attractive for the market. We're a long ways away from this, and the Fed knows that could put a stunt on our recovery. So they're actually suppressing the rising rates. Now, the silver position is beautiful, but the second that Treasury market becomes too attractive, that's the death nail for that as well. And the third potential risk would be too much inflation, like we saw in the 1970s, runaway inflation. That's what actually will put an end to the stock market rally, but we're a long ways away from inflation. I wouldn't expect runaway inflation until we have essentially recovered the jobs market, and that could take at least a year, potentially 2 or 3 years. And a lot of this does depend on policy. So right now the policy is leaning towards more lockdowns. So that's really the major concerns we have going into 2021 and to close out 2020. Now, why don't we take a quick break for our polling, Dean? and see where people are at right now with their portfolios before we jump into more of the details.
Okay, great. Great idea there, Jason. All right, team. If you are in the webinar here today, what we're going to do is launch a poll for you guys to participate in. Okay. So there's going to be 2 questions, and I'm going to go ahead and launch that for you all now. Okay. So if you go to the Zoom screen, folks, and you take you bring your cursor to the very bottom of the screen, what's going to happen, folks, is a gray bar will pop up, and you're going to see a couple icons once that gray pops up. Okay, you're going to see an icon that says polls underneath it. Okay, and it has 3 vertical bars, with the middle vertical bar being the tallest. If you can, folks, just take a few minutes. Okay, and this is specifically for the people on trial. Take that poll and fill it out, just so you guys can understand and really start to assess how much cash you have in the inflation fire currently. Okay, and that'll be something that we cover later in the presentation, but want to let you know that that poll is in the Zoom technology there, folks. And to access it, simply scroll down to the very bottom of your screen. When you do that, the pops up. You can go ahead and click on the poll icon. Okay, and then you can start filling that out. So seeing a couple of people respond to it, so thank you, folks, and make sure you do get that poll filled out, folks. Okay, so you really understand how much cash you have in the inflation fire today, and we'll cover that in greater detail later on. But thank you so much, Jason, and thank you, folks, for taking the time to fill that out. Do appreciate it. We will cover that in depth at the end of the presentation today.
Okay, very good. I do see a few questions coming in. So Rodney says, do we get out of silver? Yeah, we got out of, so our current positioning is right here. That's your only positions. We'll be back into shorting the treasury market and going long silver the second we have both the normal fiscal budget approved, and then on top of that, the stimulus approved. Until that occurs, there is some potential risks in the market. Now, I want to point out UVXY during the March crash returned 1,400%. Okay, so if we get a March-like event, that's really our only concern, is we want to smooth out the returns on our portfolio. But here's what would happen. If we got a March-like event to close out the year going into the election, you have 32% of your account in the UVXY product. Okay, so for every $320, if you end up with 1,000% return, you're turning that $1,000 into $3,200. So that's our best bet. If we get a ultimate crash into the election, you'll be one of the few investors on the planet who can more than triple their net worth from a single position. Okay, so I'm not saying that's going to happen, but if it did, you're going to have the biggest smile on your face possible. More likely is we're going to get a very modest sell-off until the government takes action, which we're already potentially at the bottom of. Okay, so stimulus and fiscal spending is the trigger to reduce our volatility protection and to go more aggressively into shorting the treasury market and going long the silver ETF. So that's really all we're waiting for right now to reduce your downside protection. But like Dean says, this is the tank. This is the atomic proof portfolio. Okay, we're going to be holding UPRO for at least 3 to 10 years without exception. Now, all we're going to do during that period is manage risk. So right now, the risk is high because we have no budgets approved for the government to keep on spending and keep this economy ticking. We also have a pretty large body of the government who wants to keep the economy locked down, even though the data is no longer supporting that. So that's another major concern, is to reopen the economy. So we're going to talk a lot more about that during this presentation. But I want you to know you're extremely protected. Okay, if you get a 2008-like crash, the UVXY product could go up at least 2,000%. If you get a March-like crash, you end up with a 1,400% return. So it's a beautiful way to be long stocks and hedge accordingly. And again, the second we get the money pumping back in the economy from the government, we will reduce our downside protection and again, short the treasury market, which has an unlimited amount of debt coming for the foreseeable future with limited demand. And so the Fed has to pick up that demand. And that's what we call quantitative easing. And that's what drives stocks higher and higher and higher. But the thing that most investors don't seem to completely understand is it's not necessarily that companies are becoming exponentially more profitable from quantitative easing. It's that there's more dollars circulating in the financial system fighting over a limited amount of goods and services, including the shares that represent those goods and services. So one of our questions is, why are companies buying back their stocks? From Robert Christie. That's a beautiful question, Robert. And so let me point out why they would do that. So Apple and Microsoft, for example, last year, for a hot minute, could actually go to Europe where they have negative rates. And what they were doing is they're actually borrowing at a negative interest rate. So that means they're getting paid to borrow money. Now think about it. Apple and Microsoft already have more money than they know what to do with. If anyone starts to become a threat, they buy out those companies. And the act of buying out those companies typically drives their market cap higher than the cost of the buyout. So they're now buying out companies for free. They're borrowing for free. And so it makes sense to continue the ascent of their stock. And they can help ensure the ascent of their stock by reducing the number of shares that have essentially a bid on all the profits of that company. So stock buybacks are a huge factor. And again, until the Fed has to raise interest rates because of inflation, this is not going to stop. So we're just trying to smoothen out the curve of our returns during periods of potential deflationary shock. So again, the government is the biggest spender in America by far. Typically, it's 16% of the economy. This year, it's probably going to be closer to 35%. So until we have completely reopened the economy, get all the kids back to school, change consumer behavior, get CNN and MSNBC and all these different media outlets to stop scaring people. I mean, in my city, I see people every day driving in their car by themselves with the face mask. I see 20-year-olds walking on the street by themselves, eating a smoothie from a juice bar, but they're taking their mask on and off while they're walking around by themselves. So consumer behavior is still not resolved. So there's some risk in the market. It makes sense to have a very healthy downside protection during this period of quantitative easing to simply reduce the volatility in our portfolio. And today we're seeing that act very well. UVXY is rising, even though the stock market's basically flat today. Okay, let's see. Loretta says in her Vanguard IRA, she can't hold. You might want to try to, so the replacement of this would be to buy the SPY ETF, Loretta. So you can simply reduce everything by a third. So if you want to do the SPY instead of UPRO, it's the same exact product, but then you would reduce the quantity of UVXY by a third as well.
Yeah, and on that, Jason, too, Loretta, one thing you can always, if you can, it depends on the corporate structure and kind of the financial structure with your employer. Okay, but you may be able to actually transfer from Vanguard to, say, TD Ameritrade. Okay, and we've had a lot of clients do that if they're able to. That way they can invest with any vehicle, because otherwise Vanguard kind of has you pigeonholed. Okay, and it's a bit restrictive. They only want you using their products, as to where TD Ameritrade will let you trade any product under the sun. Okay. Okay.
Yeah,
So,
especially when we want to play silver and short the treasury market. There's huge money to be made with those two plays, and it's almost a surefire trade the second the stimulus is passed. So yeah,
okay.
I would look at that switch too.
Yeah, and so Loretta said it's an inherited IRA. Nice, Loretta. Good to know. And that you absolutely should be able to transition that over to, say, TD Ameritrade, and then you can literally invest with any vehicle under the sun. So absolutely, my pleasure, Loretta. And Jason, Robert Chrissy said, "Wow, thank you for explaining the whole share buyback program with the publicly traded companies as well." So awesome, very cool. All right, guys, and jump in there with any questions you guys have, right? And just, Loretta probably didn't know, all she has to do is go transfer that IRA to a different company and she can trade any vehicle on the planet, right? And that's a phone call to TD. And Loretta, if you want, shoot me a message. I can actually get you a gift card sent over to you from TD Ameritrade as a referral. So it's pretty cool. We don't make any money on that, but you actually will get a gift card for a couple $100. So just send me a message, Loretta, in the Zoom chat box there with just your email and your full name. And I'll shoot you over that email for Ameritrade. And if you have more than like 100K, they're going to give you like $600 in a gift card for doing it. So there's really no reason not to. And you're going to get more vehicles too.
I'm taking a quick look at the poll results. So far, a third of the audience has taken the poll. 13% has over $1 million portfolio. We have 6% in the $250,000 to $500,000, 13% in the 100 to 200,000 range, and then the remaining 50% of respondents were under $100,000. So yeah, I do want to point out we do offer an evening webinar where it's basically the same thing, except part of your downside protection is an in-the-money put option on the SPYs. We just closed out a 35% return from a Thursday SPY put, and we closed out a 12% on the Friday SPY put, and we just bought one that's going to cover us all the way to January 15th. So I'm seeing the risk of the politicians having quite a fiasco until till mid-January. So we now have that double protection layer. So we have UVXY plus the simple SPY put option. So that's it does let you, with the larger portfolio, just sleep a little safer at night. Okay, so I'm going to go ahead and continue the presentation here. So here's what we're looking at typically first thing in the morning is looking at the breakdown of the S&P 500 to see what sectors are pulling their weight, which ones are in trouble, and to see if there's any problems coming ahead. So that's really what we're looking at here. And I want to point out in the March crash, due to lockdowns, we saw a huge advantage to anything that is basically a technology company. You shut down the real world and force everyone to stay at home. Of course, all this profit is going to flow to e-commerce and to all the technology companies. And so in the candlestick chart, we saw that work out beautifully. And banks who underwrite all the loans out there, especially with commercial real estate under fire, had the least recovery and the greatest sell-off. So now the question is, what comes to 2021? Are we going to go back into a global lockdown? And if so, should we just expect a repeat of March, but perhaps worse? Or is the opposite about to occur? Are we on the verge of a recovery, reopening the economy, and getting back to a norm? If so, which companies stand to benefit the most? And so depending on this outcome, obviously, either tech continues to dominate or the beaten up sectors begin to outperform. So let's take a look at a closer interval since this most recent sell-off. Okay, so starting in September, we had a pretty vicious sell-off, nothing like the March crash. And what led it all? Well, Tesla bubble popped. They did the stock split, and Elon Musk came in with a huge $5 billion offering. And that was the top of the market. That literally crashed Tesla, which crashed the NASDAQ, which in turn crashed the S&P 500. And so now we're trying to predict when exactly we're going to hit a bottom. And we're looking at some of these correlations. And so if we zoom out enough, we can see technology sold off the most. But again, it had risen by far the most. So what we would expect is to see at the bottom, technology should start to get a strong bid once again. So we're starting to see that today. But we're seeing a lot of weakness this morning in banks. So that is concerning, which brings me to the next point of interest. What's happening in Europe? So Deutsche Bank is showing some risk. This is the big German bank. And this is quite frankly the most alarming chart in the world, HSBC Bank. This bank has tremendous exposure to Hong Kong and is now trading below 1995 levels. It's below the 2009 crash. And this is a systemic risk to the entire market. So this is something very concerning. And we have one additional product called a Bootcamp that provides a bunch of videos to study every Tuesday. So we have a huge release coming out today, lots of content to study. And then we review it every Thursday. In addition, in the Bootcamp, we actually do currency trades. So there's one currency trade I currently really like and potentially a second, and that is to short the Hong Kong dollar. So it's trading at 13 cents to the dollar. If the real estate market in Hong Kong were to crash because of geopolitical tensions with US and China, this is the ultimate short. So we want to be shorting the Hong Kong peg. Currently, we have a 1% position in this, and the potential return is for this to go from 13 cents to a penny, which would double your net worth with a 1% position. So we really like this trade. And unfortunately, it looks like we're on a fast track towards either a Cold War or a hot war with China. And I'll play you a clip that Trump just gave to the United Nations today, just bashing China. Every signal we have is that there's a major conflict coming with China. Whether it happens before the election or after is questionable. But this is the big geopolitical risk. And the ultimate way to hedge that is, again, to short the Hong Kong peg. So that's a Thursday play. And I've been telling our members, if we do not see HSBC Bank get back above 19 by Thursday, we're most likely going to double down on that position. So besides the UVXY, to protect the American companies from lockdowns, which unfortunately we're getting a lot of signals to say that with a Joe Biden victory, you will see more lockdowns into next year. And unfortunately, that is just the truth. But yeah, if HSBC Bank doesn't rebound, this is a massive, massive bank that is a systemic risk.
Hey, Jason, and we have Roger with his hands up. So, Roger, if you have a question, bud, go ahead and jump in there and ask your question live. And team investors, any questions you guys have, feel free to follow the protocol posted on questions. Okay, and I'll actually repost that now for you here. Okay, and check the chat box, guys. And when you same thing, using the Zoom technology, go to the very bottom of the screen. That gray bar is going to pop up. You'll see the little chat icon. Okay, when you click on that, you'll see everything that's being posted into that chat box too. So we want to be want to have the most interactive webinars possible for you guys. Okay, and you guys can always use the chat to type in a question, or you can always actually raise your hand and we'll actually answer your question here live. So Roger, if you are ready, bud, go ahead with your question, please. Okay. And anyone else that has any questions, please feel free to go ahead and raise your hand. We'd love to answer your question in as much detail as we possibly can get you. Okay. And Loretta said Tesla, question mark. All right.
Tesla is a very good leading indicator of risk sentiment, and it has a lot to lose. It's gone up 1,000% almost in the last year, and the fundamentals really don't justify that. But it has been the poster child of this stock market bubble. So it's very important to watch Tesla. So I'll cover that in more detail soon. But this is what created the volatility we just experienced. Was Tesla single-handedly caused all of this. So it's important to watch Tesla. And it looks like the battery day is going to be a relative letdown based on Elon's comments yesterday. So we'll cover that in more detail. But yeah, let's take some time to do some questions. And Again, this is a bit concerning here to see the bank starting to not really perform here relative to its peers. And I think that's mainly due to the weakness in Europe, which HSBC Bank has just put a blackout for their entire company on social media. There was some files reported about big banks laundering money for bad actors, which is really not news. So something else is happening. There's a record short on the Chinese stock market. The banks connected to China, primarily HSBC Bank, are at depressionary levels. So there's something going on, and they're not telling us. So we're seeing that in the XLF ETF. So that is concerning for sure. Now the tech sector is acting very handsomely today, so that's very good for stabilizing the market temporarily. But we're below 2 key moving averages. We really want to see the QQQ get above 270 and stay above that, and we want to see the SPY get above 328 and stay above that.
Very nice. Very nice, Jason. A couple more questions came in. Roger said his question was, he raised his hand on accident. So no worries, Roger, that happens definitely. And thank you for letting us know. That's what happened. Leah asked, which electric car is next after Tesla? I think it's really over, question mark.
Well, they're all going to try to compete with Tesla on that front. So I'm not trying to be a electric vehicle expert. But my job's, we play the big markets. So I'm primarily investing you in major indexes that represent the largest assets under management in the entire world. So we're playing the S&P 500. We're playing the entire US Treasury market. We're playing the entire gold market, oil market. We're not really playing individual names. The only reason we're playing Moderna was because the figuring out the future of the pandemic is critical to figuring out the course of the stock market. So I've had to pour literally thousands of hours into understanding the virus, the science related to the virus, trying to predict the future of the virus, and then trying to predict the outcome of these vaccines. And Moderna has Bill Gates pumping it. It has Trump pumping it. It has the NIH claiming patents on it. And then once we really study the history of vaccines, the viruses that don't mutate, that are highly stable, tend to do very well with vaccines. So I'm quite confident Moderna is going to double from here. And so it makes sense to have a 1 share per $1,000. And again, I typically don't play specific names unless it involves research for the big picture. And the big picture is we need to not lock down the country, and we need to reopen the schools and get on with life and protect the elderly. So unfortunately, the Republicans want to do that and the Democrats don't. The Democrats clearly want to re-lock down the economy. And we're seeing the UK is going into a new 6-month restrictive lockdown. Australia has lost its marbles. They are arresting elderly in the parks for trying to sit down. You're only allowed to go out of your house for 4 reasons in Australia. So they're under complete control of China right now with the government. Canada is arresting people. I've got footage from Miami, cops going to people's doors. So they're starting to trace people that they know are infected. So there is a big push and debate within the government as to whether or not we should be relocking down or not. And I promise you 2 things. Number one, that's very unlikely we'll have an outcome to the election until December or January. And then the outcome of that will decide whether or not the country's going into more lockdowns or not. And if we go back into lockdowns, expect a repeat of March. Banks get crushed. Real estate gets crushed. Technology has the least volatility and probably the strongest rebound as soon as the government does big spending. Now, if we do the opposite, we reopen the economy and provide stimulus, then the beat up portions of the S&P 500 are going to greatly outperform. And I'm going to show you some data showing that we're seeing a huge shift from e-commerce sales back into normal spending habits. So this whole big outperformance of tech is going to lose its advantage if we do reopen the economy. And so that's really what we're looking at as the big debate into how to invest. Should we be concentrated in 100 top tech companies, or really just 5? Or should we have a more broader investment horizon in the top 505 companies expecting to go back to a normal lifestyle? So my evidence and data would support reopening the economy, protecting the elderly, and giving vaccines to the elderly exclusively. So that's what I think will most likely happen. But again, there is a chance that Biden wins the election, and he doesn't want to do that. He wants to vaccinate. If Biden wins, he's going to do exactly what Bill Gates wants. So that's really the story there. So Bill Gates really wants to continue the lockdowns well into next year and to vaccinate the entire world. So, and he's not, it's not subtle. He clearly states what he wants to occur, and then it's always repeated in verbatim with the Democratic Party. So he's really the one running the show on that side of the camp. Let's see, what other questions do we have out there before we jump into a lot of the analysis?
Yeah, Jason. And Leah said self-driving is next. 5G robotics, question mark, exclamation point.
Yeah, so 5G is rolling out worldwide right now. Sure. So we have exposure to that with the SPY. If we flip to the NASDAQ, we have even more exposure. But again, my base case is that we're going to reopen the economy and not do more lockdowns, and that Trump wins the election. But if that's not the case, and I don't think we're going to know who really has won until probably December or January because of the mail-in voting, then the opposite is my prediction, that we will re-lock down and that we will get another big crash, and that technology companies will have the least drawdown and the greatest return once they do go in and pass massive stimulus. So the election's critical. We're going to play it nice and safe until we have a clear winner. Once we have a clear winner, we will adjust our portfolio. With the Biden win, we basically want to predict that there's probably a stock crash initially, followed by massive stimulus secondary, and that stimulus will benefit technology companies over the general stock market. If Trump wins, there's a clear push to reopen the everything, and the S&P 500 has a lot better exposure to the companies that can outperform. So it's really just as simple as that. But unfortunately, we're not going to have a clue who's going to win on November 3rd, most likely. And it may drag all the way into December and potentially January. So that's really the key here. And now Dean's pointing out that UVXY and UPRO are going up in tandem. And so it's not necessarily the call option buying. Let me reload this. There's not a lot of option buying today. So here's the option buying today. When this is big, it's actually 1 million contracts. So market's liquidity is pretty dry today on the big indexes. As far as single names, extremely low. On hot days, we're seeing 20, 30, $40 million buying call options on Tesla. So Tesla is down 5%. That's the single most concerning thing about today's price action. So we're not seeing this big push into options.
News.
And and I think it's because there's a fiscal cliff coming. Without the government spending, the data points that create all the AI that auto trades all this stuff is going to start selling. So it's really critical that the government passes some stimulus here soon. Now, so that's what's going on here. But let's talk about, why is the UVXY product going up when stocks aren't crashing? Okay, SPY's up today. Why is UVXY going up? So this is what you have to understand, is the UVXY product is trading the front month and the secondary month future contracts on the VIX. VIX is the volatility index of the S&P 500. And so we have a beautiful, rare opportunity where market has essentially bought tremendous hedging all the way into January, but they haven't done it in September. Okay, so they haven't paid for extreme protection in September, but they are buying massive protection in October, November, December, and all the way into January. And so that means buying UVXY today is a screaming deal because we can look into the future and see what the futures contracts are trading at. So there's this massive discrepancy. Now, if I zoom out, you can see typically there's not this huge gap in the prices. So we're really in a setup where UVXY is extremely likely to trade up all the way into October, almost regardless of what anything else happens in the stock market. So it's a beautiful setup to buy your hedging today because of this price gap. Now, if you've been following us for a long time, I know some of you guys are jumping in and out on free trials, but we saw this same setup in USO, US Oil ETN. And again, it traded negative for a short minute. We bought that in a heartbeat, realizing the most important commodity in the world is not worth negative prices. And that was just a phenomenon because of they ran out of places to store the oil. So we bought that and made good money playing that oil rally. And now we're seeing this exact same setup for UVXY. So again, it's trading the two contracts. Our expectation is the red line will catch up to the black line, and that's going to drive UVXY much higher. So beautiful setup. Now, if we fall off a cliff and stocks crash, it'll go up even faster. So again, tremendous hedging is happening in October, November, December because of the uncertainties related to fiscal spending, because of the Supreme Court justice nomination, also because of the election causing mainly Democrats to, one, not reopen their economy, and two, not want to pass stimulus. So it's a whole fiasco. We have a certifiable fiasco coming into politics to close out the year, which again, if we look at the big picture, this is what we cannot forget. Okay. We cannot forget that if we devalue the dollar, there's going to be more dollars fighting over a limited quantity of resources. Okay, so who has all these goods and services? It's the S&P 500 has all the goods and services that dominate America's economy. Okay, so those shares of their stocks represent the goods and services they sell. So if we're going to flood the US economy with more dollars, we're going to have more dollars fighting over the same goods and services. So those prices are going to rise. Okay, so you've seen that. Look at everything. Prices of everything just go up, 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 up. And that's because the government keeps spending money it doesn't have. It's destroying the value of your savings. So you have to be in the most inflationary assets possible 99% of the time and simply hedge against deflationary shocks, because we know the deflationary shocks are only met with one solution: more devaluing the currency. And so they've devalued the US dollar at the fastest pace in history.
Yep. And Jason, it's so important for you all to understand that. Okay. And there's a reason why really some of the smartest and most successful hedge fund managers in the world tell you cash is trash. Okay. This is showing you guys that you're literally the cash that we've all saved and worked so hard to save is literally in an inflation fire right now. Okay. So folks, we look forward to showing you how to get that out of the inflation fire, okay, and safely put it in a tank to ride this this bubble up, okay. But really, there's only one spot you can safely put your cash in right now, and real estate. I mean, think about this: real estate was the safest investment. I mean, for the past couple centuries in the United States. Look at today. No longer that safe, right, guys? You know, absolutely, guys, get the cash out of the inflation fire, okay? And just think, for every $100,000 you have in cash, you're probably burning $10,000 a year right now, just because it's sitting in the bank or in your brokerage account, okay? And we'll cover more on that later, but just wanted to highlight how incredibly important this is to understand.
Okay, we have a question from Sol. If one has a large position in Tesla, what's the best time to exit? So yeah, I wouldn't have a large position in Tesla. In our Bootcamp product and in our Pro strategy, uh, from time to time we can play Tesla, but again, I would have a small position in Tesla, and I would be invested in Tesla when we're in an inflationary environment. So the trigger to go long Tesla would be to wait for stimulus to pass. Then you have a guaranteed hot return for Tesla, almost without question. But if we're coming into a deflationary shock because the government can't agree on how to spend our deficit, then you have a deflationary shock. So I wouldn't have the single riskiest stock as my large position when there's no government spending passed and you're on the verge of a fiscal cliff. So yeah, I wouldn't be playing Tesla until, you know, the single riskiest company in the world, bar none, is Tesla. And so you're headed towards a short-term deflationary shock that could last months. Imagine the government can't figure out how to agree on a spending bill for the rest of the year. How do you think the stock market's going to take that? So there's two bills that need to get passed. The basic budget, which McConnell declined yesterday. Okay, so that's one. That'll at least potentially stop a stock market crash. But to get a big rally, we're going to want to see the stimulus passed. And again, I think that stimulus will be around $1.5 trillion to $2 trillion. Well, real estate is at risk if people lose their jobs and can't pay their mortgage. So a lot of people have lost their job. And if Joe Biden wins, there's no question he wants to lock down the country. Now, you could ask why on God's green earth he would want to do that, but he's going to say it's to squash the virus. Their main argument is that the economy cannot recover to a norm unless they eradicate the virus completely. And so their outlook for when this can be achieved is 2022, mid to late 2022. So yeah, that's a scary thing to think about. Who does it benefit? Oh yeah, the tech giants, doesn't it? Who does it destroy? The banks and the small businesses. So that's really the big concern in that point of view for real estate. Yeah, so for, you know, why put all your eggs in Tesla when you could buy the entire S&P 500 and eliminate business risk? So yeah, we don't want to put all our eggs in one basket. So we have the top 500 companies with UPRO, and we're protecting it with a volatility index that tracks exactly the S&P 500. So it's a match made in heaven during periods of risk. So this is and that's typically when you can make the most money, is when you invest during a period of high risk, the market's going to reward you the most. So that's why we want to keep our positioning despite the deflationary risks we're facing right now. At the end of the day, the more the market sells off, the bigger the stimulus and the faster the government comes to terms. And so the market's figuring that out. They realize the longer this goes on, potentially the greater the stimulus. Now, the Supreme Court justice nomination is a wrench in the gears. So that's what I do. I pay very close attention to all the macro economics and politics that can be an earthquake for the financial markets. And again, I hate to say it, but we would love for stocks to fall off a cliff. That would be our single best return to close out the year. If we get a March-like event into the election, it'll be the best return in our track record's history. On the other hand, we get the market to float higher until stimulus is passed and then it skyrockets. We do great. We're gonna outperform the S&P 500 because we have UPRO, which is essentially taking your net worth and tripling it. So yeah, there's a lot of uncertainties in the market. As soon as we have a president elected, we can start to really evaluate how to modify the portfolio. But bottom line is, with Joe Biden, I would expect another sell-off, which is met with big stimulus, and that it is advantageous to technology stocks. So I would be going into the NASDAQ and dumping the SPY with the Joe Biden win. I'd be looking at clean energy related investments. So they are anti-carbon emissions. So oil is no longer that attractive. Copper is extremely attractive. Okay. They want to do nuclear energy globally. So all of a sudden uranium's interesting. Okay. So there's big differences in policy that will affect our investment decisions. If Trump wins, their plan is to rush out. They're actually building these little trailers all over the country right now, which allow people to come in and get their vaccines. But Dr. Atlas came and clarified something very important. The vaccine is optional. Okay. Bill Gates does not want the vaccine to be optional. He's quite clear that he thinks unless the entire population of the planet Earth is vaccinated, we will never eradicate the virus completely, and it's going to keep coming back and keep causing economic damage. That's his whole argument. Okay, but the policy Trump's pushing is different. He's pushing to reopen the schools immediately and to rush the vaccines out to the elderly. Okay, so he wants to reopen the full economy. So they have different policies. If a Trump victory is in play and we can potentially force stimulus and a budget and a Supreme Court nominee, well, then you got to own the S&P 500. It has much more catch up and potential profit ahead compared to the tech stocks. So it's just as simple as that for me. And until we know who's the president, you better be hedged. So we're going to protect like a maniac until we have a clear stimulus passed and a clear president elected. So those are the two big obstacles we need to achieve. Normal fiscal spending budget approved. Okay, so that ends in 8 days. 1, 2, we need the stimulus. Okay, until the economy has all restrictions removed and consumer behavior is not one where you're afraid to go outside without a mask, then we have to be hedged. So that's how we have you positioned. You're long stocks, but you have extreme hedging until we eliminate the uncertainties in the market. Once the uncertainties in the market are relieved, then we can start to get more aggressive. The way to get more aggressive is to short the treasury market and to get aggressive with long silver. Now, I love gold if we're predicting QE's coming, which we did, and made a ton of money for clients playing gold. In fact, I think we sold almost close to the very top. Now, the next big push that will outperform is silver, because we're already in the beginning of QE. I'm expecting QE to last for 2 to 3 years at a minimum. So that's really the time period where we want to play precious metals. So huge opportunities ahead. Right now, and with all the uncertainties, we're going to keep it very simple and very safe. So this is all you do. Per 1,000, you buy 10 shares of UPRO, you hedge it with 12 shares of UVXY, and inside job, this is a complete inside job. Moderna is almost guaranteed, unless their vaccine has terrible results, which I highly doubt, but it is a potential risk, then I'd expect Moderna to at least double into its phase 3 results and potentially go higher. Okay, Sol's saying, so please expand. The best way to get out of Tesla is to sell it immediately and replace it with this setup, Sol. This is far smarter. I mean, why put all your eggs in Tesla? I mean, for heaven's sakes, look around. When I look around at companies that have market caps in that range, they all have a monopoly. So Apple iPhones are everywhere. Microsoft is everywhere. Is Tesla everywhere? No, they have a tiny, tiny share of the market. So this is just a massive bubble in Tesla. Does that mean we don't want to ever play it? No, but I wouldn't touch it unless we had stimulus in the books. As soon as we have stimulus in the books, Tesla is really the only company that's not covered that's worthwhile in the S&P 500. So I would add Tesla after stimulus is passed. And it's clear we're not going to relock down the economy for the next year, which is scary because we're seeing other democratic societies start to get more aggressive with lockdowns, even though hospitalizations are falling off a cliff, deaths are falling off a cliff. They're completely making these assessments now on cases. But for heaven's sakes, if we went and tested everyone for every common cold, we would never reopen the economy ever. So yeah, the best strategy is to immediately build this portfolio and then sit back. 2 time horizons. We're going to hold UVXY until stimulus is closed and a winner is declared on the election. Okay. Once that is achieved, then we can go back into shorting treasuries and going long silver, assuming it's a Trump victory. If it's Biden, I would exit UPRO, probably short the banking sector, and get ready to buy technology stocks the second they pass a multi-trillion-dollar stimulus deal, which would probably be massive and next year. Okay, yeah, so I don't have any more advice for you on that, Soul. You're playing with fire.
Yeah, and I just read him a message too. I told him, he said he's specifically talking about scalping. And guys, this isn't a day trading service, right? And it's important to know there's not a single billionaire on the planet that day trades or that scalps or that swing trades. It's really important to know that they manage risk, right? They use incredibly strict risk management. They're not day trading. Okay. And I mean, go look at Warren Buffett, look at what he does. He doesn't swing trade. He doesn't day trade, nothing of the sort. Okay. Long-term investments with incredibly strict risk management. Look at Ray Dalio, the only person on the planet that's returned over $100 billion for his customers for over a 20-year period straight. Just manages risk. He's long or short 3 asset classes. That's what we teach people how to do, Sol. Create large sums of generational wealth, not make sandwiches with an insane amount of risk in the portfolio, right? So this is how to become wealthy, and not how to try to make $1 million overnight. Okay. And it takes time, guys, and it takes strict risk management and the ability to make money in up markets and down markets, right? That's how Dalio specifically has made the most money in the entire money management category, right? And it's strict risk management. These long or short 3 asset classes. It's really simple.
Yeah, so a good analogy is we're growing a garden. We're not making a sandwich. So a lot of the products you've probably seen have this mentality that they're hyperactive, and they're basically trying to make a little sandwich to eat every day. So they want to get in and out, make a little sandwich, and then that's it. And so that's a fun game. But again, like Dean said, no one's become rich making sandwiches. If you want to get rich and become wealthy, or at least keep your wealth where it is and grow it faster than inflation, the only strategy that works is to grow a garden. So this is how you safely grow a garden. So I'm going to go ahead and hop into a little more content and then leave it to Dean to close out. So let's just take a look at what's on my radar screen. So banks are showing a lot of weakness today. That's very concerning. So we got to keep close eye on this. This is very problematic. We really want to see the banking system recover. I would estimate that there's something going on with HSBC Bank that's not being made public. That's a massive bank. And for it to be trading this low is highly concerning. So we're keeping a close eye on that. And we're also seeing that contagion spread into US banks through the entire index of XLF. So that is highly concerning. The other main concern is that we can't get more government spending approved, which is what's keeping people's rent paid while they have no job. And governors and mayors continue to keep their cities locked down for no damn reason. Okay, so that's what I'm seeing of interest in this chart. Okay, Tesla is enough to create short-term volatility in the market because it's extremely overvalued, whereas Apple is big enough to create an entire stock market crash. It's the single most important company in the world, and the key level to watch on it is 110. And so it's trading right at 110 today. It was as low as 106 yesterday. And so while Tesla could predict potential 10 to 15% corrections, a serious long-term decline in Apple could create a much more dramatic sell-off. So those are 2 of my favorite risk indicators to keep a close eye on. Here is our normal strategy, which most of the world relies on. I'm gonna go to a monthly chart. It's called the risk parity strategy, and it's very simple. You buy half your capital in stocks, half of it in US long-term treasuries. And when stocks crash, the treasuries hedge you automatically. Okay, so stocks crashed 50% in 2008, treasuries rose 45%. Now, what happened to your treasury position if you just held it blindly? Did it lose your money? Nope, it went up over time. Okay, so treasuries have been historically the single safest way to hedge your portfolio. They can go up with stocks over time, but they really go up when stocks crash. Now, we were predicting that this was going to no longer be the case because the Fed had manipulated interest rates. So when the stock market went from this point to here, we should have seen the treasury market go from this point to down here. Instead, the Fed did $3 trillion worth of treasury purchases and kept the treasury at a flat rate. So our prediction was that in the next downturn, treasuries would fail to do their job. Okay, and so look what happened. Stocks corrected approximately 10%. Treasuries stayed flat. So cash is trash and treasuries are trash. You have no option. Stocks and precious metals. Now, precious metals are highly dependent on fiscal spending, so we're holding off on going long silver again until the fiscal is back in action. So here's another look at the big markets. We have in yellow the S&P 500, the NASDAQ in the candlestick, and the Treasury market in blue. And again, with a Trump victory, we're expecting the S&P 500 to catch up and close the gap with the NASDAQ. With the Biden victory, I would actually expect another stock market crash because of lockdowns, followed by many massive stimulus packages to recover the economy and a continued outperformance for tech. Now, remember, who's really controlling Biden? It's the tech giants, without question. Who's really in favor of Trump? The big banks. Okay, so those are the big two parties of power here. Now, this is really interesting. This is Treasury market against precious metals. When the Fed manipulated treasuries, we had this very weird, I was telling investors, every correlation you have learned to know broke on March 16th, right here, when the Fed manipulated the markets at the fastest pace in history. So we saw treasuries and gold going up together. But now the Fed's letting price find fair values at a better degree, and we're seeing what we would expect. Gold is a currency debasement hedge first and an inflationary hedge second. Okay, something like copper or oil is the pure inflationary hedge. So what we would expect is if the deflationary treasury product goes down, that gold should go up. So that correlation is back. So that's good news that the market's starting to behave as it should, so that we can make a lot of predictions based on correlations of various assets. Now, the biggest bank to be concerned about in the United States is Wells Fargo. They have the single largest exposure to commercial real estate in a total dollar value. They don't have the highest percentage of their balance sheet on commercial real estate. And this was obviously big news when Warren Buffett completely exited Wells Fargo and airliners. Now, who's his best friend? It's Bill Gates. Who did he talk about highly during his most recent shareholder meeting? Dr. Fauci. What do they both want to do? Lock down the entire world through 2021 until they can ramp up vaccine production to be able to produce about 7 billion vaccines times 2, because all of these take 2 doses. So they need to be able to produce 14 billion vaccines. What's even crazier is these vaccines have to be stored at extremely cold temperatures. So it's not something they can pull off quickly. They may be able to rush out some vaccines to nursing homes, but what they can't do is get the entire world vaccinated very soon, probably by the end of next year. So Wells Fargo was completely sold by Warren Buffett. So this is a critical company to track. If this goes below 22 and HSBC is below 19, I predict that there's systemic risks in the banking system. They're not being disclosed to the public, and we will increase downside protection. So right now it's flirting with danger, just like HSBC Bank. So we're keeping a close eye on it. This is the most important US bank to track. So I'm looking primarily at Wells Fargo in America, Deutsche Bank in Germany, and HSBC Bank out of London as the three critical high-risk banks to follow. Okay, oil's been very predictive of stocks. So in January, China had to deal with the pandemic before everyone else. And this predicted the March crash 3 months early. It predicted this most recent sell-off early as well. And so I do look at oil as a tremendous leading indicator to the health of the economy. Now, China's starting to slow down its purchases. China is the growth engine of the world. So if this dips below 40, prepare for volatility. Currently at 42, not telling us to be concerned. Okay, Europe is facing negative interest rates. That is the death knell for their banking system. Probably one reason HSBC Bank is so low. Lloyd's Bank is getting in some trouble. So we're seeing this show up in their stock market. Now, Lagarde decided not to push for more QE in her most recent statement, with their euro trading quite expensively. Now, we have seen that pull back and the dollar rise in the last 2 weeks. But this is problematic. If we're going to expect stocks to go to new highs, we need to see world stocks keep up. They don't need to outperform, but they need to at least track the same direction. So Europe's starting to show some weakness and most likely will lead any stock decline. And this is with IEV. Okay, China is printing some very good numbers, but what's interesting is that many analysts don't believe the numbers. Their foreign reserves are not matching up with the exports. And we're seeing evidence of bank runs. We're seeing evidence of, well, in their stock market, there's the single greatest short position in Chinese stocks in history today. Why? Why, if they're having these record-breaking recoveries from the pandemic? So again, we want to see EEM break past 46 and stay above that level to indicate a long-term bull market ahead. Now, it's not showing the weakness of Europe, so that's a good sign so far. Here are the futures contracts. UVXY is set up beautifully. So this almost, without question, will rise into October because of this discrepancy. But if we start to fall off a cliff with stock prices, which could happen because of the government failing to spend, then this is really a great position here coming into the end of the year with so many uncertainties. Okay, gold to copper ratio is a really beautiful way to predict interest rates. So if we're recovering, we're going to be bidding up the price of copper, which we use to build things, faster than we bid up the value of gold, which we usually do early on in a recovery because of currency devaluation. So we can see there's a clear trend for copper to rise at a faster pace than gold. This is predicting higher interest rates, lower bond prices, and higher stock prices ahead. Now, even during this 10% correction, month over month, interest rates across the yield curve have all risen. This is our primary prediction that the Fed is going to allow interest rates to rise because it's highly beneficial to banks and will help pull money out of precious metals, out of the tech sector and into the banking sector, which again is what we know is what the Fed's main objective is: protect the big banks who own the Federal Reserve. Okay, debt issuance is large this week, so that's good news for collecting money for the Treasury. Problem is, they already have a lot of money. Treasury's sitting on $1.7 trillion, and the House and Senate can't agree on how to spend it. So they're not going to be spending money after this month until they start passing more spending bills. So that's a huge problem ahead. this is where the Fed tells us ahead of time what their QE plans are for the future. And so my expectation is they don't change this at all until there's more stimulus, which would increase the issuance. There's just not enough debt for them to be buying right now. Julio's asking if UVXY and UPRO could go down at the same time. If we traded very flat, then UVXY would go down and UPRO would go down together. But the market's really not set up. When you have this much money being flooded into the economy, and you have this much uncertainty, and you have this much stock buybacks, my prediction is that it won't stay flat. We're either going to crash because the government won't spend money, or we're going to take off like a rocket because the government's going to continue spending massive amounts of money it doesn't have, which causes devaluing the dollar, which makes stocks go up.
Yep, and pretty cool too is just checking on the portfolio here, guys. S&P 500 is up 0.3% right here. Portfolio is up 1.2%. So we're outperformance. The factor literally is an incredible rate today per normal if the market is actually going up. So awesome job there, Jason. It's funny. It takes a while to explain how we outperformed to the upside, but safer. But great job on the portfolio structure, bud. Once again, it's just beautiful.
Yeah, you gotta love it when your hedge is going up with your main position. I'm gonna play one clip for you guys, and then go ahead and leave the rest of this presentation to Dean. Keep in mind, if you like this sort of content, I've barely given you the tip of the iceberg of our pro membership presentation, which is every Monday, Wednesday, Friday. And we do spend about an hour covering markets, and then we spend about an hour covering politics. So I'm going to play one piece of the politics for you. This is very important. The relationship between US and China is really critical to understand. And so this was a speech for the United Nations today. So I'm going to play this, take any last questions, and then leave you with Dean here.
As we pursue this bright future, we must hold accountable the nation which unleashed this plague onto the world, China. In the earliest days of the virus, China locked down travel domestically while allowing flights to leave China and infect the world. China condemned my travel ban on their country, even as they canceled domestic flights and locked citizens in their homes. The Chinese government and the World Health Organization, which is virtually controlled by China, falsely declared that there was no evidence of human-to-human transmission. Later, they falsely said people without symptoms would not spread the disease. The United Nations must hold China accountable for their actions. In addition, every year, China dumps millions and millions of tons of plastic and trash into the oceans, overfishes other countries' waters, destroys vast swaths of coral reef, and emits more toxic mercury into the atmosphere than any country anywhere in the world. China's carbon emissions are nearly twice what the U.S. has, and it's rising fast. By contrast, after I withdrew from the one-sided Paris Climate Accord, last year America reduced its carbon emissions by more than any country in the agreement. Those who attack America's exceptional environmental record while ignoring China's rampant pollution are not interested in the environment. They only want to punish America, and I will not stand for it. If the United Nations is to be an effective organization, it must focus on the real problems of the world. This includes terrorism, the oppression of women, forced labor, drug trafficking, human and sex trafficking, religious persecution, and the ethnic cleansing of religious minorities. America will always be a leader in human rights. My administration is advancing religious liberty, opportunity for women, the decriminalization of homosexuality, combating human trafficking, and protecting unborn children.
Okay, so that's one clip. One clip I do need to play in tandem with it. This is important. So the big risk with Trump is the likelihood of decoupling with China and potential war with China. I want to show you one other video. And this was put out by the Chinese this weekend, or rather yesterday. And let me grab it. And this is just showing you that the tensions between China and the US are deteriorating or rising quite quickly here. And so while I have a lot of this data here to show you, again, McConnell rejects Democrats' funding bill last night. Tracking devices here rolling out in Singapore. Great. Here's a lady in Australia where they're about to arrest her for sitting on a bench. Just showing you the unfortunate, there's a lot of countries that are getting more draconian here. But this is the most recent video from the Chinese that basically blowing up Guam.
I posted it in the chat.
Oh, great, thanks. And this is from Bloomberg, who's pro-China, which is really shocking to see them place this on their feed today.
中国人民解放军东部战区在台海附近组织实战化演练。台湾是中国领土神圣不可分割的一部分。
台湾问题纯属中国内政，不容任何外来干涉。任何以台制华、挟洋自重的企图，都注定是死路一条。
So we just sold 5 huge defense systems to Taiwan. So yeah, the battle between U.S. and China will be the big story of the next decade as well. So, all right, guys, let me go ahead and leave you with Dean from here after I take any last questions. Again, we spend a lot of time covering all of the geopolitical issues as well as domestic political issues on our longer pro webinars, where we also trade options on top of that. So very good.
Nice, Jason. Excellent presentation as always. Thank you, sir. Appreciate it. Okay, guys, I'm going to go ahead and transition over to my screen here. Looks like we had probably everyone fill out the poll. So thank you for that. But if you're just joining us now, if you haven't filled out the poll, please go ahead and do so, folks. And it'll just help you understand how much cash or how much what the inflation fire is literally doing to your cash. So if you're in a money market account right now, guys, it's not the time to be there. Okay, that's going to devalue substantially. You're guaranteed to lose money in that setup. If you have a couple $100,000 in cash, you're guaranteed to lose money by having that in the bank or just sitting in cash in the brokerage account. All right, guys, so it's time to put it to work, but you want to put it to work safely. Okay, so let's go ahead and take a look at the portfolio here, and let's look at how much we're outperforming the S&P 500 right now with a beautiful level of protection engineered and structured in our portfolios. So I'll go ahead and take over the screen here, and we'll take a look at the accounts following here. Okay. So let me make sure I'm on the right account. Okay, perfect. All right, guys. So let's take a look here, and actually first we'll look at the S&P 500. Okay, and I'm going to grab my pointer here just to show you guys kind of where I'm focusing, because I do move fast, and if I'm moving too fast, just tell me. Okay, guys. So as you can see here. Okay, actually, how do I? There we go. Okay, so as you can see here, the S&P 500, the SPY, right, is up 0.24%. Okay, so that's good, up day in the market, that's great. But let's look at our account here, and this is structured with the $100,000 when we started, right? So we can see that we're up 1.1% because we're up $1,118 on just 100K. Okay, so that shows that we have a performance of 1.13% here. Okay, so if we take that number let's take that number and let's see what our exact outperformance is to the S&P 500 today with an incredible amount of protection built in. Okay. So we're going to take the, we'll just take 113, right, for easy math. So that represents 1.13%. Okay. And once again, the S&P 500 was up, let's take a look again, 0.28%. Okay. So once again, 1.112% here. It just changed a little bit, and the S&P 500 is up 0.28%. So we can very easily take the 113, simply divide that by 28, guys, and see that we're outperforming the S&P 500 by 403% currently, safely protected, hedged, in case anything between the US and China gets wild. Okay. So just wanted to point that out, guys, and just show you. And look, I'm showing you what happened to the portfolio for the day, just to show you purely the mathematical and mechanical examples of what our portfolio does. Now, are we day trading? Do we look at this on a daily basis? No. Okay. You know, and it's really good to understand, folks. We're here to create generational wealth. Okay. Not to try and day trade on a daily basis. So I just want to make that super clear. In our industry, probably 99% of the people out there are trying to sell some type of day trading crap that's never going to make you money, right? Or some type of strategy that shows you how to use technicals, right? That's literally 99% of our industry. We're a lot different. Obviously, we're trying to show you guys how to create generational wealth. Okay, and literally show you what the most successful investors on the planet have done. That's the same strategy that we're showing you guys here today. Okay. It's all about proper risk management, right? Having that hedge in place. Okay. And giving you the ability to actually make money in down markets. Okay. So very cool. So just wanted to touch on that really quick. And I think it's important to take a look at it at any points in time. Does that make sense for everyone? And I know we have quite a few new people in here today, a lot of names I don't recognize. So Alan Davis, did that make sense? RT Libre, did that make sense? Barbara, did that make sense to you? Clark M, let's see here. Frank, D, James Ross. Hey, James, hope all's well. Let's see here. Geronimo Medina, welcome back. I know you're in here yesterday. Leah, let me know if that made sense to everyone. Okay, Loretta, Coral, please let me know if that made sense to you. Let's see here. And we have Mike A. Robert Lloyd, first time I've seen you in here, so thank you. Nancy Lang. Okay, Sass, Selena, Soul, Steve, TCMM. Okay, Tribute HD. Any questions on that, guys, on how we're outperforming the market by 400% to the upside with an incredible level of protection? Actually, we have 32% of our capital is hedged for downside protection. Okay, but we still get the outperformance because we're using a little leverage. Okay, and literally, guys, the reason why we're using the leverage is because of stimulus and QE. Okay. And if you look back historically at the only times that QE has been in place, the market doubles at the fastest rates in its market history. Okay. Yeah, Leah. So certainly. So guys, there, and it's good to know, right? Leah had a great question. She said, "Is it better to buy in small increments?" So great question, Leah. Okay. And there's two systems that we have, guys. Okay, so our buy and hold portfolio, okay, is wonderful if you're using if you have under 100,000 total to invest. Okay, buy and hold is great, and you can literally plug and play and scale this per $1,000 you have to invest. Okay, so buy and hold specifically, guys, is really kind of engineered and structured for people that have under $100,000 total to invest. Okay, now the pro portfolio that Jason covers in the afternoon webinar, and it's only paid clients that are in that group, right? Those are our clients that are using hundreds of thousands and literally millions of dollars behind our portfolios. Okay, but so it's important to know, buy and hold really good for under 100K. Okay, the pro portfolio though, the tranches are in $25,000 increments. Okay, so there's basically 2 ways you can plug and play and scale our portfolio setup today that outperform more to the upside and have less drawdown. Okay, so buy and hold. Great if you have under 100,000 to invest. Okay, this is what you want to sign up for today. Okay, if you have over a couple 100,000 to invest, you absolutely want to sign up for the pro strategy. And then tomorrow at 3 Eastern Standard Time, Jason will be covering the exact setup of that portfolio. And I know he just took some really nice profits on some of the put options that he had. And that portfolio actually made 4% from Monday to Friday with a huge amount of volatility in the market. I think between the 2 days, the Dow Jones lost over 1,000 points, and the pro portfolio made 4% in that time. Okay, and so the pro, guys, is going to show you how to have a lot more protection. Okay, and really, you're going to not only have a really bulletproof setup. Okay, but you're going to actually have options on top of your bulletproof setup to give yourself even more protection, right? So really, guys, we have our pro portfolio. It's really attractive to investors with over $100,000 to work with. Okay, that's what I'm personally using with my IRA that has my largest sum of capital of any of my accounts. Okay, and it's just awesome, guys. You sleep like a baby at night knowing you're hedged. Okay, so yeah, there's really, so pro portfolio, this is going to be tranches of $25,000 in the portfolio structure. Okay, and the buy and hold, you can do tranches of really $1,000. Okay, so pretty cool. And really, the buy and hold is going to be bulletproof. Okay, and as to where the pro portfolio, guys, is really going to be literally atomic bomb proof. And and the whole thing, guys, is just to create consistent returns for you guys, show you the risk parity strategy that Ray Dalio has used to deliver record $100 billion plus returns for his clients over the span of over 20 years. Okay, so we'll go kind of deeper into what we do, what it looks like for you guys as a client. Okay, so just want to check on that. Once again, outperformance 1.2% here. We take a look at the market. Okay, it's 0.33% up. So right around the 400% outperformance to the upside factor here today in the portfolio structure. Okay, so cool. And thank you guys for that, and want to welcome and thank you all for taking the time to join the investment webinar today. Okay, so please, I hope you all have enjoyed the education so far. We're gonna have a little bit more, okay, but please ask questions along the way. The more questions you ask, guys, the better you're gonna understand how we help our clients and why. Okay, so just jump in there at any point with any questions. Okay, let's see, you know what, and Loretta said, NWO Income G. Loretta, I'm not too sure what you're referring to. Can you help clarify a little bit on that? That would be greatly appreciated, guys. And you can just, to get to the chat box too, to type in your question, just scroll to this area. Okay, a gray bar is going to pop up, guys, when you do that. When that gray bar pops up, just click on the icons. Okay, and if you haven't yet, click on the poll icon and fill that out. Okay. But very cool. And yeah, and Loretta, if you can, go ahead and unmute your microphone too. You can just raise your hand and then Ryan will unmute your microphone. We'll actually take your question live. Would love to understand exactly what your question is in better detail. New World Order. Yeah, so yeah, there's some powers that be, certainly, and really, Loretta, it's important to know there's literally about 100 families that control about 50 to 60% of the liquidity in the U.S. equity, bond, and precious metals market. Okay, and they're the people that control the Fed. Okay, so I know there's a lot of conspiracy stuff about the New World Order and such. Really, guys, those 100 people, those 100 families control the entire financial system. Okay, and the Fed is their puppets. Okay, and the Fed completely controls the stock market, the bond market, and the precious metals market. So that's what we attach to, guys. And the whole thing and the whole point, right, is to simply partner with the casino. I was telling Leah earlier today, you can partner with the Bellagio, in Vegas, or you can go to the Bellagio in Vegas and try to take your shot at gambling against, one of the most successful casinos in Vegas. I would rather partner with them, make money day in, day out, right? Really just, on a monthly basis, I'm making money quarterly, right? Just like a publicly traded company, guys. In finance, you want to look at your results on a quarterly and annualized basis, right? So that's what we're going to do. And honestly, guys, the best way for you to make money at the Bellagio on a quarterly and annual basis is to partner with them, right? Literally attach to their ecosystem and help them, right? And really, or you could be the gambler that's at the table, seeing if you can beat one of the most successful casinos in Vegas. I would rather be the partner that's going to make money year in, year out, no matter what. Okay. So yeah, not too sure about the New World Order, Loretta, but I can tell you there's literally 100 families that control the bond market, the stock market, and the precious metals market, and they do it through the Fed. Okay. So that's why we pay so much attention to what they do. All right, guys. So we truly appreciate your time and attention to show you how boring successful trading can be when you actually have the right strategy. Okay. So make sure to save my number, folks, and call me and text me if you have any questions after the webinar. Okay, it's 505-322-7515. That's literally my cell phone, guys. So feel free to send me a text there. Okay. Now, we help investors profit safely and develop consistency. It's at the core of our design and approach to the markets. Okay, please meet our team. We have Jason on the left here. He's our Chief Investment Officer. I'm in the middle here. Folks, I'm the Chief Investment Consultant. So Jason helps our existing clients. Okay, I help all of the people we have on trial and all the people that don't want as much volatility in the market and have a way to make money in down markets as well, so they can consistently grow their wealth. Okay, and then eventually pass that down to their kids and their grandkids. Okay, Ryan is our Chief Technical Director. Okay, so all the technology you guys see, all the cool automations that are built into your technology ecosystem with our product, that's all Ryan's hard work. Okay. Now, when you sign up for your when you sign up for your trial, folks, you're actually going to get text messages and emails from all of these people that you see below. Okay, they're our investment consultants. Okay, and they've been sending you text messages and emails. Okay, so feel free to reach out to them at any point in time with any questions. They're awesome. Okay, and you could have a text from Damien, Wendy, Ryan, Robert, or Keith specifically if you're in the UK. Okay, and they're great people, guys. Look, they have our portfolio structured, and they're having a blast learning with us for what we do and why we do it. Okay, so feel free to reach out to them or me at any point in time. All right, so meet the team. Right on the left is me, on the right is Jason. Okay, and Jason's your resource for any investment questions. And if you're a paid customer, he's going to be your resource for any questions you have. Okay, for anyone on trial, I'm going to be your dedicated resource along your trial period, folks. Okay, now the mission of Portfolio Builder, in essence, for us is an incredibly complicated process to deliver, and it takes a ton of hard work on our side, guys. But really, in the end, our mission for you as an investor is really simple. Okay, number one, engineer and build the safest growth for your hard-earned nest egg. Okay, number two, educate you on how the central bank controls the market and attach your capital to it. Okay, number three, answer any and all questions you have about our portfolios in live interaction in our exclusive webinars. Okay, now, so who are the legends we studied, and why did Jason and I spend literally decades doing this, right? Well, it's interesting, folks, because we were fascinated when we started running these numbers, right? We looked at hedge funds that delivered profits for their clients for more than 10 years. There's quite a few of them. Okay, we looked at hedge funds delivering profits for their clients for more than 15 years. That number got much smaller. And then we pulled the number out to 20 years, right? And that actually pulled us through 2000, the 2008, right? When we ran these numbers. Well, guys, there's only 3 on the planet. Who are they? Jim Simons, quantitative hedge fund, Renaissance Technologies. Okay, he created the first quantitative hedge fund. It's done incredibly well, but you can't actually give Jim money to trade for you today. He's closed. He's not accepting new capital, and honestly, folks, he will never accept new capital at the rate that they're growing. So you'll never have an opportunity to invest with Jim. Okay, Stanley Druckenmiller. All right, he actually closed his hedge fund in 2010. He now has a family office, so you actually can invest with him. Period. Okay, now Ray Dalio, his fund is not accepting new money currently, and they actually ran into liquidity issues this year, but that's not something you're going to have to worry about at all, folks. So when Dalio has to enter and exit positions, it literally takes him days upon weeks sometimes to enter and exit positions. That's where our client base can do this in 3 seconds. So we're actually able to outperform Ray with his strategy. Okay, and that's what we deliver for you guys. All right, so these are the only 3 humans in history that have been able to generate gains for more than 20 years straight. Ray has returned the most money, so we look deeply into what he does. We literally found out that he's long or short 3 asset classes: bonds, stocks, gold. That's it. That's it. 3 asset classes, guys. That's all the most successful money manager in history has invested or positioned into to make the most money for his clients of anyone in the world that's ever done it. Simple. KISS, baby. Okay, so we crunched the numbers and we discovered all 3 assets are controlled by the Fed. By allocating our portfolio's greatest concentration to bonds, stocks, then precious metals, we've invested ourselves with the same goal as the Fed. Okay, next, we add a kick to it by using leverage to outperform the market. Then we add risk management components to bulletproof the setup. To top it off, we monitor the markets 18 hours a day, 5 days a week, so you don't have to. Okay, but you guys can come to the webinars all you want to learn more, right? And the more you learn, the more weaponized your brain is, and the more you can help your kids and your grandkids understand what we're doing and how to create generational wealth. Okay. And really, guys, so I go on vacation, and I follow what I'm doing, and I'll be in the air later today. Okay, but I can replicate trades right from anywhere. I have cell phone service on my phone, right? And it's really cool because you, as the client, you can come every day religiously and learn all you want. Okay, or hey, you guys can sit back and relax, place the trades. Look, I know a guy in Atlanta that's one of our clients that's using over $4 million behind us. He doesn't even come to the webinars after the first couple of weeks because he's so comfortable with what we do, and he literally golfs every day and trades from his phone. Okay, but we'll send you guys the trade alerts if we need to make adjustments to the portfolio. And literally, folks, you get it right to your cell phone. You open your brokerage account if you need to make a change, and you make a change, and you go back to enjoying your retirement or running your business or whatever it is you like to do, your passion projects, maybe hanging out with your kids, your grandkids, right? Whatever that looks like for you all. Okay, so many of our members make the cost of our membership or more in either a few weeks after they purchase or during their trial. Okay, and our trading plan takes less than 2 minutes to execute at the set time of 11 Eastern. Okay, my challenge to you is to see how much you can make over the trial period. And I want to ask you, is there a better way to build trust? I haven't found one yet, but would love to know if you can think of one. Okay, so here's a cool screenshot, guys, of our top trial student making $97,019.89 during his free 7-day trial. Pretty cool, guys, and it's important to know because we had risk management in place and because we actually switched to safe haven assets back in March. I got this email during the worst sell-off in the past, no joke, 20 years in the U.S. stock market. Okay, and then if we go take a look at some of our other emails, right? We could take a look at Mark making $108,000 over the span of 2 days. Well, guys, that was exiting safe haven positions while the market was tanking. Okay. Don here, he'd been in the markets for 63 years, had never made $100,000 in a single day, and he did it on March 18th. Okay. Literally the worst sell-off day of 2020. Don made over $100,000 in 1 day. Okay. Now, did he do this day trading? Absolutely not. But did he do this with safe haven assets that we switched to because we understand risk management and risk parity? Absolutely. Okay. So we love to sleep like babies at night, knowing we're using risk management to protect our hard-earned nest eggs. Proper risk management provides consistency and reduces stress. Okay. So I'm going to go back on that first slide I started on, right? When I was telling you guys the core of our design is to structure the most safety for your money, but to grow it too. But our rule number one came from Warren Buffett. Never lose money. Rule number two, don't forget rule number one. Okay. Now, so if you don't know this guy, this is Ray Dalio, right? So this is the most successful money manager in history as far as consistency goes and how much he's returned for his clients. In my opinion, the by far and away the best way to look at who has the best system in place. Okay. So what's the number one unknown risk to US investors today? Okay. It's actually cash in your account. Okay. Unknown risk, right? There's a lot of known risks, sure. But I can't tell you how many people I talk to every day, guys, okay, that literally don't understand what the inflation looks like today. So we're going to look at this. And Dalio's famous line, cash is trash, absolutely loved it. Okay. And because I understand that, right? And I'm glad you all are here today so we can help you understand that as well. All right. So did you know your cash is burning up sitting in your brokerage or bank account? Even if it's a money market account, guys, it's literally on fire. I mean, literally think of this as your money. Okay. So why? Well, the Federal Reserve is printing money at the fastest pace in US history. And guess what, folks? That's not going to stop for years. It's going to take years to get us out of this global depression. And folks, it's important to know this is the first time the entire world has went into a synchronized global depression at the same time. It's never happened in human history before this year. Okay. Well, I guess technically you could take Sweden out of that equation because their drop in GDP, I believe, was only 6% at its peak, and already they're at 4% drop in inflation or GDP. I'm sorry. So technically, every single country on the planet went into a coordinated global recession outside of Sweden this year. Okay. So you can leave your hard-earned money in the inflation fire, or you can learn to invest it safely today. And I got to tell you, folks, 99.9% of every investor I've ever talked to in the United States isn't using proper risk management. Okay. But I get it. Look, the advisors have told you your whole life, just, dollar cost average, just always slam your money into the market net long. I don't agree. I don't agree at all with that. And I think it should be a crime for these people to be able to tell you that. Okay. What they should be showing you is proper risk management and how to make money in any situation. Okay. So let's take a look at 4 examples to show what inflation is doing to your capital right now. Okay, we're going to use 3 simple variables in our examples today. Okay, cash, location, time. Okay, so if you're in Dallas, Texas, I'm actually going to be flying there shortly after this webinar to go grab a car. But if you're in Dallas, Texas, okay, and you have $400,000 sitting in your brokerage account or in between your brokerage and your bank account, okay, and obviously, guys, you want to think about the money you're not going to need for the next year, right? But let's just say your name is George. You're sitting in Dallas, Texas, watching the presentation right now. You have $400,000 in your brokerage account, but it's not invested because you're scared of the global recession. I get it, okay? But George here probably doesn't understand that he's actually going to lose $30,000 annually to inflation because of the inflation fire. Okay. That's his cash burn rate on an annualized basis. Think if he holds it for 3 years, guys, that's 90 grand. Okay. Example B, if you're in Miami, Florida, wonderful city. Honestly, one of the most fun cities I've ever been to. Okay. 11% estimated annual inflation currently. Okay. And if you're on the coast, guys, your inflation is going to be much, much greater anywhere you are in the United States. Okay. Now, the calculation of the inflation burn rate for, let's say it's Jose, okay, in Miami. Okay, they're at about 11%. Even at only $250,000, Jose's losing $27,500 annually, okay, to inflation. Now, example C, the Bay Area. Love this city. Love Napa, right? Great place to be. Have a lot of family actually out in the Bay Area. Okay, and I was shocked, folks, when I went through the numbers with my cousin that's in the Bay Area. He's at 13.5% annual inflation. Insane. Okay, look at what his calculation burn rate is. Okay, no joke. And my cousin, no joke, literally had $1 million sitting in cash until about 2 months ago, and it's now working with us. Okay, and we sat down and I was like, look, Ronnie, you're losing $135,000+ a year to inflation, and we got to get it to work, but you got to put it to work safely. Okay, but look at this, guys. If you just have $250,000, you're in the Bay Area, you're losing $33,750 annually to the inflation burn rate. Okay. Now let's take a look at example D, right? Manhattan. Love Manhattan. I was just telling Leah actually before we jumped on this call, how, the most fun things to do in New York, the restaurants and the live music, you can't do. And, New York City has 32,000 restaurants inside of it. And I wonder how many of those are going to go out of business. Is that going to be 15,000 restaurants? It's crazy, right? But so let's just say, you're in Manhattan, you have $1 million in cash between brokerage and bank account. Okay. Or if it's just in a money market. Okay. Literally, folks, in Manhattan, you're seeing about 12.5%. Okay. And that's a pretty soft number. Okay. It could certainly be a lot higher. Okay. But look at this, guys. If you have $1 million, you're sitting in Manhattan right now watching this presentation, your inflation burn rate is $125,000 annually. Okay. That's insane. Multiply that times 3 years. Good Lord. It's a lot of money. Okay. So let's take a look and see what inflation does to your capital currently in the examples below, right? So we just take those 3 examples and let's look at it, right? And it's crazy because if you're in Dallas, you're losing less money than the person in the Bay Area that has $150,000 less in cash, but it's because of the inflation burn rate so much higher, right? So interesting to take a look at these examples. And then think about this, guys. The Fed has no choice. They are pigeonholed to print Benjamins, okay, or I should say they are licensed to burn your money for the next 2 to 3 years, and they're pigeonholed into doing that, okay, because they have to get the US consumer to spend money. What's the number one thing that gets all of us to spend money as consumers? Higher stock prices. We spend more money, okay? We buy more items when the market's up. It's a weird thing, right? But that's how do we get GDP back? Well, get US consumers to buy goods. US GDP, folks, is 70% driven by us spending money in the economy. What's the number one way to get it back? Print the markets higher. Okay. So don't, and don't let this, guys, turn into a 2 and 3 year ordeal. Oh my Lord. Right. And it's good to know too, guys, every time that we've had quantitative easing, the S&P 500 has doubled in a very short time frame. This is the 3rd time in history we've had quantitative easing in place. Write it. Okay. But safely. Look at the rise and fall of the US dollar. Look, the moment the Fed was created, folks, bye-bye value of the dollar. Okay. And it's literally, if we could see 2020, right, it'd be okay. So how much capital do you have working for you? And how much capital do you have sitting in the bank or a money market being gobbled up by inflation? Okay. And and you just want to make sure, look, guys, you want your numbers to be up here, not here. Okay. So let's take a look and see what the portfolio design is today. Okay, after you complete the poll. So anyone, if you haven't completed the poll, I hope you have, but to access the poll, if you haven't yet, scroll down to the very bottom of your screen here, folks. Okay, when that happens, a gray bar is going to pop up. Okay, click on the polls icon. Okay, it's 3 vertical bars, the middle vertical bar being the tallest. Click on that and fill out the 2 questions in there. Okay, and if you're watching this recorded, okay, don't watch the the live stream from YouTube, right? That means you're not one of our clients. Guys, get signed up, right? And then that way we can interact here live and work through some awesome questions and some awesome education every day. Okay, so if you haven't yet, guys, fill out that poll real quick. Okay, and it looks like I'm going to read the questions on the poll really quick, and then we'll go to look at the portfolio structure after this. Okay, so so the question of the poll, okay, and it's good to know, guys, this is anonymous, so no one's going to know what your answer is. Okay, and Ryan, can you see the poll in my screen? Didn't know if you can actually see. Can you guys see the poll in my screen here? Okay, I'm going to okay, yep, I'm going to take that as a no. Okay, cool. So thank you, Ryan, appreciate that. So guys, it's really good to know, right, and understand, what does your cash fire look like today? Right, so that's the name of the poll. And question number 1 is, investors, it's critically important to review how much cash the Federal Reserve is burning in your ecosystem. Okay, so let's seriously think about the cash you have sitting in your brokerage / bank accounts / money market accounts, okay, in this exercise, and please select a response. Okay, so response number 1 is less than 25K. Response number 2 is 25 to 50K. Response 3 is 50 to 100K. Response 4 is 100 to 200K. Response 5 is 200 to 500K. Response 6 is 500,000 to a million. Okay, and response 7 is 1 to 5 million. Okay, and it looks like so far, and this is anonymous, guys, so please feel free to go ahead and fill out that poll. Let's see here. 10% responded saying they have between $1 million and $5 million bucks in cash. So consider your inflation burn rate. Super glad you're on the webinar here today. Okay. So 10% of the people had between $1 million and $5 million in cash. Okay. 5% had between 200 and 500,000 sitting in cash. 14% had between 100 and 200,000. Okay. 14% also had between 50 and 100,000. 19% had between 25 and 50,000. Okay, and 38% had 25K or less sitting in cash. Okay, very good. So totaling up all those numbers in general, hopefully we helped you all understand how to save literally 7 figures in inflation across the group. Okay, number 2, why are you letting your cash burn today? Is the second question, right? 24% of the people responded said they honestly had no idea inflation is burning my cash at the fastest rate in US history. So beautiful. 24%, that's great, guys. We're helping a lot of people understand that. Okay, 43% said I'm looking for a safe place or portfolio system to invest with currently. Beautiful. Okay, we would love to help be that solution. Okay, 19% said I had big losses in 2000, 2008, and Q1 2020. Just hesitant due to the big losses. Absolutely understand, folks. Okay, and you know, absolutely understand that. And look, folks, just want to let you know. Look, Ray Dalio that we based our strategy on made money in 2000. He made money in 2008. Okay, and guess what, guys? We made 9.2% return in Q1 in the pro strategy, while the market was down about 34% at its peak. Okay, 5% said they just fired a money manager or liquidated a mutual fund. I'm looking for a new vehicle now. Absolutely. And I can't tell you how many people fire their money managers that are our clients. I think we've probably had a couple hundred fired at this point. Okay. 19% said, I just got control of my IRA or 401k and I want to invest it safely. Beautiful. Okay. 19% said, I'm still looking for the next 1000% return ultra stock. Yeah, I get it. That was me in my 20s as well. Okay. Early 20s, anyways. Okay. And 5% said, I like letting my hard earned nest egg get less valuable on a daily basis. Well, yeah, there is that option. Okay. So awesome, guys. Oh, and Leah said she can't get the poll going. Okay. And Leah, you may have already filled it out, actually. But if you go to the bottom of your screen here and you click on that polls icon, that should pop up for you. Okay. And the pop-up may have just went to another screen or something on your computer too. Okay. So very, very cool, guys. And Leah, and I know what your ecosystem looks like right after our phone call this morning. So that's good. All right, guys. So let's take a look, right? Let's look at how you can put that money to work. If you, really, guys, if you're using less than 100,000, okay, this is what it looks like. This is it. And you can plug and play and scale it per $1,000, right? So let's just say you're an investor that has, let's call it today just for fun, 65,000 in cash, okay, money markets or in your bank account or your brokerage account. Let's just say that number 65,000 for you today. Okay. This is how you can structure it to outperform the market, but safely do that. Okay. So we simply take this $65,000, right? And we take our instructions here to buy 1,000 shares, right? Because this is our tranche size is 1,000. So we take our 65K and we simply divide that by 1,000, right? So we see how many tranches we're going to build. And the simple math tells us that we're going to build out 65 tranches. Okay. So that's all we have to do, guys. In a tranche is just a set amount of capital that you're going to invest. It's a term that's very commonly used, and I'm sorry about my writing here. Okay. Still figured out how to write with the mouse here. But you're going to have 65 tranches, right? So you take these instructions, buy 10 shares of UPRO, take that, multiply that times 65. Boom. You're going to have 750 shares of UPRO. Okay, that gets you your net long position, step one. Step two, buy 12 shares of UVXY. Take that, multiply it times 65. Okay, I'm going to just grab my calculator really quick so we can do this on the screen here. Okay, where did it go? Okay, let me pull the calculator into the screen. Okay, so I take the 12, multiply that times my tranche size of 65. Okay, and I'm going to understand that's 780 shares of UVXY. That gets me my protection. That bulletproofs my portfolio. Okay. So go back to my annotations here, right? All right. Looking good. Okay. Now the last one, okay, is Moderna, right? It's rare that we have an individual company, guys, but when we give you one, it's a wonderful opportunity. Okay. But you want to keep the exact risk management. You don't want to go overweight this position. Okay, so we take the instructions to buy one share of Moderna, multiply it times 65, right? Everyone knows that that's going to be 65 shares. And guess what, guys? With literally some real simple mathematic calculations, okay, you can build your portfolio today to outperform the markets and always have a hedge, okay, in case stuff between the US and China gets gnarly. And let me tell you guys, it's pretty gnarly, right? And really, in the end, I think the whole COVID thing was engineered as financial warfare, right? And Jason will go kind of deeply into the, that side of things in the pro. Okay. But literally guys, okay, and what I'll do guys is, so this is the 650 shares, right? That's of UPRO, the 720 of UVXY, and the 65 of Moderna. So pretty cool. Okay. And that's it. That's how you guys structure 65. That's how you take 65K out of the inflation fire today, structure it behind the buy and hold portfolio. Simple. Okay. Now the pro portfolio is a little bit different. Okay. And it's also using options. Okay. So not only do you have UVXY, but you have some put options on the S&P 500. Okay. And we actually just took really nice profits from Friday. Well, we structured our first put option on Thursday. We added another put option on Friday last week. And from those additions and the gap from Friday to Monday, we made 4% in the pro portfolio. Okay. Or if you're using $40 million, that's 40 G's that you just made over the weekend as the market sells off. Okay. So pretty cool. And the weighting will be a little bit different in pro too. And you'll do a little bit more trading in the pro. But really guys, if you have less than 100,000, click on that link in the chat box. Okay. And get started with the buy and hold. But if you have well over $100,000 in your financial ecosystem, go with the pro guys. Okay. Really it's just so nice to have that added level of extra protection. Okay. And so it's important to understand too, right? So I do both of these portfolios across my IRAs, 401ks, Roth IRAs, right? All the different investment accounts that I have. Okay. And does that make sense to everyone real quick too? Just wanted to make sure everyone's super clear. But just wanted to show you guys how easy it is to plug and play and scale and build out our portfolios. And literally guys, it may take you 3 or 4 minutes to do that total. And it's how you plant your seeds in your garden. Okay. Does that make sense to everyone in here? Barbara, does that make sense? Leah, MG, Mike A, Robert Lloyd, Sass, Selena, Tribute HD. Does that make sense to everyone? And hey, we have Tracy Huggy in here, one of our buy and held clients. Nice. Tracy's going to be liquidating a gym here pretty soon and bringing about $500,000 into our ecosystem. Beautiful. Okay. Rodney GP. Hey, Rodney out in Florida. Hope all is well. Let's see here. Robert Lloyd, first time in. Okay. Robert said, yep, makes sense. Leah, makes sense to her. Awesome, guys. So yeah, simple. Okay. Simple stuff. And let's go ahead and I'm going to go ahead and remove my drawings here. Okay. And we're going to scroll down once again to look at the structure. Okay. And I'm going to use some different colors here. Okay. So our long is at 66%. Okay. So that's our green. Now we're going to have our hedge though. Our ambient here. Some people call it. To hedge our risk. Now, it's beautiful, guys, because in this position, you literally have 505 of the best companies on the planet when you just own this ETF. And here's the thing, they're going to pay you to own it. Okay. So, and I talk to a lot of people each day that have, 50 companies in their account, right? So, but this is literally, guys, 505 of the best companies on the planet, bar none, right in that UPRO ETF. Okay. Once again, your 32% is your volatility hedge, right? So that's your protection. Okay. So we'll just write this out. That's your protection. Okay. Okay. And Moderna, folks, is the leading vaccine. Some crazy technology. Technically, if they can do what they're doing with coronavirus, they'll actually cure the flu too, which would be nuts. right? So that's why it's rare that we do this, but you know, this is the vaccine really and a hedge to the coronavirus, right? So we're always hedging in some way, shape, or form. Okay. So it's really simple, guys. And instead of having, you know, 40 companies, 50 companies in your portfolio, you can have three or two ETFs in one stock, 3 positions. Way easier, right? Cool. All right, so I'm going to go ahead and clear up those drawings, and then we're going to go to another slide here. Okay, so just so you guys can kind of understand better what the core position is. Okay. Now let's take a look at one of the best performing ETFs that's ever been created, by the way. Okay, that you can own today. So we own the S&P 500 with a free leverage ratio of 3-to-1 without paying for margin or loans. Okay, and look, folks, if I go to TD Ameritrade right now and I want to get that 3-to-1 leverage ratio, they're going to charge me 7.2% annually. UPRO is going to pay me to have that leverage. So let's take a look under the hood of UPRO today to see why it outperforms the market in a huge way. So let's look at its core asset classes, right? So really, guys, the S&P 500 swaps, all this swap stuff you see right here, that's used to create massive liquidity. Okay, and I'm actually talking with some of the people over at ProShares to see if we can have someone technically come in and show us the insane amount of work that they do to go and use leverage trade and deliver us they pay us to deliver their work to us. Okay, so hopefully in the near future, maybe next month or so, hopefully is what it's kind of looking like. Hopefully we're actually going to have some of their people show us how that works. Right. And it's crazy complicated, but I've never actually seen inside of it. So I thought it'd be cool for all of us to take a look at. Okay. Now, what are the core stocks the asset holds? Well, it's all the best, guys. It's literally 505 of the best companies on the planet. They're already inside of UPRO. Okay. And not one of them isn't profitable. Not one of them is a huge risk. Okay. And it's neat, guys, because you're diversified across all sectors. So let's take a look. Let's look at the sector weighting. Okay. So IT is 24% or 27%, healthcare 14, consumer discretionary 10, communication services 10, financials 10, hardest hit outside of energy this year. But that's the value play, guys, in the rotation up, right? Industrials 8%, consumer staples 7%, utilities 3%, real estate been one of the hammered sectors this year too, 12.84%. Energy 12.83%, materials 2.52%. And it's interesting, folks, energy used to be up here. If you look back, okay, you literally look back into the 2000s, energy was the top index in the S&P 500. Okay, now tech is. And guys, that number is never going to slow down. The growth of that weighting, because it will eventually disrupt all of these industries. Okay. Now, what are the top 10 index companies in the UPRO engine? Okay. So you can look at the weighting per index, right? So Microsoft, Apple, Facebook, Amazon, Google, Johnson & Johnson, Berkshire, Visa. Hey, there's Warren again, right? Visa, Procter & Gamble. So how and when are you paid to own UPRO, our core position? Well, it's pretty cool, guys. Actually, today is the last day to buy it to then get paid on the 30th. Okay, because its ex-dividend date is the 23rd, and you got to hold it through the 24th to then get paid on the 30th, and you're going to get paid quarterly. Okay, now with the way the dividends and expense fees are working currently in UPRO, and this can and will fluctuate every quarter. Okay, but this is how it's set up right now. Your net return per 100 shares should work out to an annualized dividend of $1.32 per year per 100 shares. So in essence, UPRO is paying you to own it. Pretty cool, right? And instead of paying 7.2% to get the leverage of 3-to-1 at TD Ameritrade, I just own UPRO. So what does the performance look like since its inception? Okay, and this is crazy, folks, but that's right. Its average is 33.18% since its inception. Okay, and that's great, right? But we want to protect the asset with protective hedging for a safe ride. We do this work and watch the market 18 hours a day, 5 days a week, so you don't have to. And literally, folks, the trading time for the buy and hold portfolio will take you less than 30 minutes a year, probably less than 10, honestly. Okay, and the amount of time you're going to take to replicate the trades, even if you never came to a single webinar with the pro, maybe that took me 8.5 hours to do all the trades for the pro and the boot camp last year. I actually calculated it out and recorded it. 8.5 hours to make a substantial gain in my portfolio. Okay, so let's take a look down and understand the buy and hold, right? Really good, really, guys, great for accounts under 50K. Okay, and if you're under 50K, this is where you want to be for now. Okay, it's at 80% less drawdown compared to the Dow Jones in 2020, and it's had a 39.78% outperformance to the Dow Jones on the upside to date. And we just looked, guys, and we directly compared our UPRO position to the S&P 500, and we're outperforming by 400% today, currently. Okay, so this portfolio uses ETFs to be, and this is, I aggregate this data every month, guys. So you'll see this data change as we get into new months. So this portfolio uses ETFs to be long or short specific asset classes. It's super simple. Minimal changes throughout the year. Okay, we only made 5 changes in 2019. Okay, I think we've had 3 total portfolio changes in 2020. Super simple, and literally it will take you minutes to do these trades and positions. Okay, you're gonna have 15 hours of live education and Q&A every week. Okay, now do you have to go there? No, but if you want the education, come every day. Okay, no options are used, yet return 25.31% in 2019. And made money 1 month when the market was down. Pretty sweet. Okay, my 7-year-old, folks, is following this system. No joke, you can too. Okay, and our free bonus is 30-day access to our $9,997 option trading bootcamp. Okay, buy and hold trades are going to be done at 11 Eastern every Monday through Friday on the dot at 11. Okay. So, and this is really cool too, guys. The membership fees are tax deductible. No longer can you deduct the fee of a money manager. No longer can you deduct the fee of a hedge fund. You used to be able to. However, you can still deduct our costs to help you grow your money. So what's better, right? A net negative entry for you. There's really no net cost to you. Okay, so what would you rather do? Get our help or pay the federal government more tax money? It's a pretty simple answer for me. Okay, so what does the buy and hold performance look like? So guys, the red ovals above are showing the monthly drawdown of the S&P 500 and how we performed. Okay, so the green up here is our track record. The red ovals is what the S&P 500 closed at for the month for the performance. Okay, so notice we've created 6.8% return. Okay, in 2 months where the S&P 500 fell 1.97% total in August of 2019 and January of 2020. Okay, so pretty cool. And you're also going to see these other months, right? Well, the January 2020 market was down. We made 2.47% because we switched a heavier amount of safe haven assets. Okay, February, the market was down 8.41. We had less drawdown at 0.299%. March, the market finished down 12.51% for the month. Okay, we had drawdown of 6.73%, and the outperformance, guys, massive. Let's take a look and let's see what the Dow Jones has done for the year so we can get a comparison. Okay, give me just a second, guys. And I know this month or this number is always small, but the Dow Jones year to date is still down 4.83%. we have really substantial gains and the Dow is still down for the year. Okay. So pretty cool. Now, reduce your drawdown with us for the rest of your life when you click on the link in the chat box and sign up today. Okay. So pretty cool, guys. And it's all about hedging risk, balancing risk, always making sure you have a backup plan. Okay. We tell people, look, you can be on the motorcycle without the helmet on, going down the freeway and going across the country on a road trip, or you can be in a tank. Okay. And if the motorcycle gets hit by the car, well, the motorcycle rider could die. They could be paralyzed. Okay. And think about it. In 2000, 2008, Q1, a lot of investors felt paralysis from those times in the market. Look, our pro portfolio clients, guys, made 9.2% in Q1. Okay. So the pro portfolio, guys, is very attractive to investors with 100,000 plus to work with. This portfolio will show you how to trade like the best hedge fund managers on the planet without the 2% management fees and performance fees. Okay, guys. And this is really important to break down. So let's lay these fees out and let's compare these fees to what we do. Because really, guys, the people I am competing against and Jason are competing against, right, in our company, we're competing against the best hedge funds on the planet. Okay. And we want to show you the difference of what that looks like. Okay. So there's one calculator. Let me grab another one to pull over here, folks. Okay. And that way we'll look at literally the difference between the two. Okay. Let's see if I can shrink this one down a little bit too. There we go. Okay. So the hedge fund is going to charge you a 2% management fee. Okay. And they're also going to take 20% of your performance when they make you money. Okay. So let's take a look at the difference. So let's say you have $1 million. Okay. That's how much you're going to invest with capital or with us today. Okay. And there's a couple of you in here that have that, right? So let's take a look at this. What does a management fee look like at 2%? Okay. So we take our million, multiply it times 0.02 for 2%, right? Okay. Their management fee is going to be $20,000 a year and you can't write it off. Okay. Now their performance fee. So let's say X hedge fund makes you a 20% return. Okay. So you have your $1 million. Oops, I actually hit the wrong button. Sorry, so $1 million and 20% return, right? So we're going to multiply it times 0.20. Understand that's really simple. It's $200,000. Okay. But they're going to take 20% of that performance number. So we have to multiply that times 0.2 once again to understand that their performance fee, guys, is actually going to be $40,000. Okay. So let's go ahead and enter that. So when you should have had a $200,000 profit, right? If you would have been doing the actual placing the trades, okay. But between their management fee of $20,000 and their performance fee of $40,000, okay, you have to subtract $60,000 off your $200,000 profit, and you're left with $140,000 profit. Still a killer return, right? You don't have to do anything. But if you're willing, folks, to actually learn, okay, and be able to teach that to your kids and your grandkids once you do learn risk parity and risk management, okay, you guys can avoid the $60,000 in fees if you're willing to do about 8 hours worth of work a year. Okay. And then, like I said, you could teach your kids and your grandkids, right? So that's the difference, guys. Okay. Now let's take a look here. And with our pro portfolio, we take that $1 million notional sum. Okay. We make you 20%. I think that's extremely conservative over the next year. Okay. So $200,000. And guys, if you take that, our 200,000 that we make you, okay, and you subtract our lifetime fee that we have available until we close out 100 spots there, okay, but it's something that's available to you now today. Look, guys, you subtract that off, you're left with 180,000 instead of 140,000. Okay, that's a difference of more than 40,000 bucks in your pocket. And guess what? The hedge fund that's going to charge you $60,000 every year, that cost doesn't go away, and you can't write it off, right? So we just determined that with the hedge fund, okay, that fee is $60,000 a year. Okay, let's look at that fee over the next, let's call it 20 years. You're going to pay the hedge fund $1.2 million in fees over 20 years. Our lifetime package, guys, is 20 grand, $3 shy of it. And you never have another fee again. Okay. So pretty cool. And if you need a tax write-off for your business, or maybe you've made a lot of money in the market, or maybe you just sold an investment property or a house or a commercial building or whatever that looks like, and you have a bunch of capital gains exposure right now, guys, get our help for the rest of our life before that offer goes away, right? And literally, we're going to give 100 people that offer to the lifetime, and then it's gone. Okay. So pretty cool. All right, guys, and I'm going to go ahead and shrink down these calculators. Okay, so changes will be made on a weekly basis to ensure maximum protection of your capital. Okay, you're going to have 6 to 8 hours of live education and training every week. Okay, and you're going to get a sophisticated balance of core asset classes. However, guys, you simply buy the ETFs. We've spent the 34 years researching how and when and why to own what in the markets. Okay, you don't have to do that. You don't have to spend those countless sleepless nights, and still something I do every week, and on a daily basis. I'm putting together hours worth of research in the markets. Okay, but it's pretty cool. Options are utilized to completely atomic bomb proof your capital. Okay, and pro members really enjoy the exclusive content produced each and every day in their webinars. There's no trials in the pro portfolio. Okay, so it's only really, guys, sophisticated investors, wonderful questions that come through that. Okay, and really people using substantial capital behind what we're doing. Okay, so the free bonus when you sign up for the pro today or the buy and hold is a 30-day access pass to our $10,000 option trading bootcamp. Okay, our exclusive pro trading is every Monday, Wednesday, and Friday at 3 Eastern. Okay, and once again, guys, you can use our cost of the membership as a tax deduction for the year in which they are made. Okay, we also have our boot camp. Specifically, folks, this program is for the investor who wants to learn how to fish in the options market, what lures to use, and why. It's perfect for the investor looking to grow their knowledge on the options market. Okay, and not only are we going to train you on the option market, how it works and why, but we're going to send out option trades specifically to take advantage of lucrative opportunities and powerful ongoing training that come from an experienced trader's desk. Okay, so it's pretty cool. Not only are we going to teach you how to fish, what lures to use and why, what weather conditions to fish in, okay, but we're going to hand you some extra fish as well with our option trading. Okay, and so far, guys, I'll have to recalculate the numbers on the latest closed out trades from the boot camp, but before the numbers that came out yesterday, or I'm sorry, we actually closed out the trade today, but we're averaging 68% return in those trades. So it's a nice way to get a little extra alpha from option trading. Okay, so and it's really cool, guys. That's going to be on Thursdays at 3. Okay, and once again, it's tax deductible. So last but not least is our all access VIP lifetime membership. Okay, you're gonna get your own exclusive webinar on Tuesdays, and it's really neat, folks. There's other investment opportunities outside of the US equity markets that we cover in that presentation as well. Okay, so you're gonna have select trades and VIP only webinars geared to the elite investors, only available to our all access VIP lifetime members. And once again, it's tax deductible. So if you need a write down, folks, for your business or for capital gains from stocks or real estate, whatever that looks like for you all, great way to hedge some of that off and get our help forever. Okay, and you can click on the link in the chat box to select that option. Okay, guys, so what is the only chart you need to see in 2020, 2021, and 2022? Okay, so this is the chart that I stopped Jason during his presentation to talk about how important it is. Okay, guys, and it's important to realize we have about 3 times the amount of quantitative easing going on this time because of the pandemic. So it's a wonderful time to get your money out of the cash inflation fire and working for you. Okay. And the bond market, guys, if you have mutual funds in the bond market, or if you have like a Vanguard product in bonds, it's not looking good. Bonds do not do well with this much quantitative easing in place because of how the financial system functions. Okay. So bonds are risky, cash is risky. The Fed is forcing you into equities right here. Okay, so protect and grow your hard-earned nest egg today. Just sign up in the chat box, guys. If you have any additional questions before you do, give me a call, 505-322-7515. That is my personal cell phone number, guys. So if you want, you can actually just send me a text and say, hey, Dean, this is Barbara is in the webinar. I'd love to chat. Or, hey, Dean, this is MG. I was in the webinar. I'd like to chat. Or, hey, Dean, this is Mike A. Hey, Dean, this is Robert. Hey, Dean, this is Selena. Okay, hey, Dean, this is Tribute HD. And I'll respond, guys, in the order that I do receive your text. Okay, so 505-322-7515. Now, if you want to also, if you're outside the United States, if you want to call me, just use +1 and the same number, 505-322-7515. So click on the link now, guys, in the chat box to get started and get instant access to the $10,000 bootcamp program for 90 days as a free added bonus. And you'll learn all about that trade that can potentially make a 12,000% return, shorting basically China's Hong Kong dollar. Okay, because there's a great opportunity for that to go out, and it looks like our bootcamp content just went out as well. Okay, so if your client that bootcamp content went out, nice. Dalio's in it this week. Very cool. In the bootcamp, guys, we send out a content email every Tuesday, and it's all the best interviews that we've watched over the past week that we condense into an awesome YouTube playlist, and we send out to you every Tuesday. So when you sign up today, guys, you will get that email after you sign up too. Okay. So pretty cool. And once again, call me if you have any questions, guys, 505-322-7515. We truly look forward to the honor of helping you and your family grow your capital in the safest manner possible. Really, the financial side's fun, but more than that, guys, okay, getting you the education so you can teach your kids and your grandkids. Okay, because that's super important, and that will not only help you, but that will help your downstream, right? Your kids, our seeds, right? In our own little garden. Okay, guys, any questions at all? I think we're good. My pleasure, Sass. Thanks for joining us, bud. Okay. Robert, let's see here. MG, Mike, Robert Lloyd, MG, Leah, Barbara, any additional questions, guys? Okay, I think we're all set. All right, team. Well, we will see you back either in the buy and hold webinar or in the pro webinar tomorrow, depending on which option you choose, and absolutely look forward to seeing you in there. Thank you so much for your time and attention, folks. Have a wonderful day. We'll see you in the next webinar.